I just thought I'd update you. Last time we spoke in November, after Rachel October budget, and my concern then was that she raised £45 billion, and my concern was that she'd have to come back for a second bite of the cherry for more tax. And the reason is that she had it's not a technical term, but she had £9 billion under the bed money, i.e. for a rainy day. Now, to give you an idea, £9 billion out of a total budget of £1.23 trillion, and a trillion has 12 noughts, is 0.9% of the total spend, which isn't enough money. Since then, the things that have created more problems are wars, tariffs, and my own bugbear is the non-domicile tax. So the non-domicile tax, they reckon that the government, it will cost them about £12 billion. So to give you an idea, the Livingstone brothers had just left the UK. They said their annual tax bill was £104 million. So £104 million, if you think your average taxpayer, that will take 21,500 people on average tax to pay that. So the government need to raise a lot more money. So I, well, just to let you know, I'm predicting budgets, so don't think this is going to be right, but if you look at anything like that, all these sacred cows that you never thought would have happened before. So I never predicted that they would have suddenly said that pension money is all taxable. Whereas before it wouldn't be. Now, if I died today and if I had £1 million in my pension, that's 40% that's going to be that the pension company pays on my behalf from my estate. And then whatever's left, i.e. in that case £600,000 after paying £400,000 tax, if that goes to my kids, and if they're high rate taxpayers, they're going to pay 45% income tax on drawdown on £600,000, which means your tax bill is effectively nearly 67%. Now, I wouldn't have predicted that, but then again, as far as I'm concerned, all bets are off. So if I look at, say, 3 items that you need to look at in the billions to raise money in the billions. So, and I don't know if they do any of these, but they are things that I never thought anyone would do, but they need the money. So if you look at, say, one of them, VAT, the government said they weren't going to increase. So VAT, it brings in about 15% of the total tax. And that's about £710 billion. And the government said they weren't going to raise any more money with VAT. However, they did it with school fees. And they said that they announced that before they were elected, so that kicked in with effect from July. So anything that happened after July with school fees, even if you paid it in advance, if you hadn't paid it by then, you're going to pay VAT on it. So I don't think they will, after them saying they wouldn't change that, I don't think they'll do anything more on the VAT rate. But how about on the basis that with income tax, they've frozen the thresholds for 8 years, so till 2028, you're in something called fiscal drag, which means that even if your salary just goes up with inflation, because the tax rates don't go up, you're dragged into a high rate of tax. So broadly, if you earn just over £50,000, you're going to end up into 40% tax, even if you just got a pay rise. So they aren't keeping, they aren't keeping in line with inflation. You could say the same things about the inheritance tax rates, the capital gains tax. Exemption for capital gains tax has gone down to £300,000. Inheritance tax exemption is £325,000. You can claim a residence nil rate band if you leave your property to your kids. However, if your estate is more than £2 million, then that's going to get eroded. More than 2.35 million, it goes back to zero. So you only get £325,000. You can leave that between your spouses. So with VAT, you might say, well, how generous is the threshold of £90,000? So if you think that the average salary in this country is about £34,000, if I was a self-employed person with little direct costs, say a computer consultant, window cleaner, electrician with little direct costs, I could invoice £90,000 to my customers on a self-employed basis and not charge VAT. Now, you could say, well, where are we compared to our competitors? So in Spain, the first €1 that you spend is VATable. There is no base level that's exemption. Most of the European countries, Germany, France, Portugal, Netherlands, their threshold is no higher than €25,000. So we're by far the highest threshold. So the government could say, well, how about we reduce the VAT threshold down from £90,000, just an example, £45,000. That'll bring in £1 billion. And that means that if I'm a self-employed electrician charging £90,000 a year, and my customers are Joe Public, so they can't recover the VAT, if you reduce the threshold from £90,000 to £45,000, that means that £45,000 of my income is now subject to VAT at 20%, brings in an extra £9,000. So then you multiply that, that's going to bring in about £1 billion. So that's number one. Number two, and this is a real life example for one of our clients, got a client that bought an investment property in 1990 for £150,000. That property is now worth £1.75 million. Done nothing special to it. London property market, in that case, in 35 years, has just shot up. Now, that means that that person has a capital gain, a gross capital gain of £1.6 million, which is 1.75 million less £150,000 purchase price. If the guy gave that property to the kids, the new rate of capital gains tax is 24%, which broadly means he's got a capital gain of £400,000. So that's what's called a dry tax charge. He gives the property to the kids, gets no money for it, and then he ends up paying £400,000. You think, wow, that's a big number. What could be worse is you say, look, I'm not going to pay the tax. They can sort it out when I die. Well, if he dies, or when he dies, that's 40% tax, because it's inheritance tax. Let's assume the exemption of 325 is gone, because it's already been used up. 40% of 1.75 million. Well, that's £700,000. So these numbers are pretty eye-watering. So what you've got to do is you've got to think, well, how can we get around that? If you've got a spouse and exemption and uplift, upon death, he could leave the property to the wife. She gets it at market value. So therefore, because there's no tax between spouses, he leaves the property to the spouse. Her deemed purchase price is 1.75 million. She then gives it straight to the kids, no capital gain. That is £1.6 billion if they got rid of that. And the last one, pensions. I never thought they'd tackle pensions. Now, at the moment, a number that trips off the tongue is your pension allowance is £1,073,100 if you take 25% tax-free. So that's £268,000 that you can get out of the pension. At the moment, that is totally tax-free. If the government says, I'll tell you what I'll do, we'll limit to £100,000, which means that not 268, but £168,000 of that is taxable, 45% because it's in the higher rate of tax, that gives you nearly £2 billion. So that's three ideas of, I call them sacred cows, but that would bring in a lot of money. The government have got to bring in billions, and that's the figures they're looking at. So that just gives you three ideas of things that might happen. I'm not saying it will, but they're looking at the billions because they're so short of money. So anyway, gives you a bit of food for thought. I know Steve wants me to wind up, but if there are any quick questions, let me know. Okay, great.